Hello students, let us discuss about the insurance subject today. Let us have the definition of the insurance, concept of insurance and other terminology related to the insurance. Now let us discuss about the objectives of the insurance business. One of the important objectives is to introduce the concept of the insurance business, importance of insurance in the economy, to introduce the concepts of risk, insurance contract and its essentials, to define the insurance and related terms, to explain the revolution of the insurance business in India, to discuss various types of insurance present in the market. The insurance plays a vital role in the economy. It provides for risk mitigation and alternatives to the owner of the assets and saves from the disasters. It also inculcates the habits of saving and acts as the social security norm. The genesis of insurance can be traced to 17th century and London. From the Lloyd's Coffee House in London, the insurance spread worldwide and grown as one of the significant component of financial product and services. These institutions dealing in insurance business have become major chunk of financial intermediaries, mobilizing savings, cost-effective fund sources for developmental activities of the government. Insurance is a risk pooling and risk sharing mechanism. The people interested to save their assets pooled together and constitute a fund known as the insurance fund. This is done by contributing their share known as the insurance premium and indemnifies the person who suffers loss because of loss of asset on happening of any accepted uncertain event. Though there was no specific law to govern the insurance transactions and managed under the company's law, later specific law known as the law of insurance was developed. The expansion of business has triggered further strengthening of the insurance law by enacting specific branch of law in the field of insurance business. There is a close interaction between the insurance and economic growth. As economy grows, the living standards of the people increase. As a consequence, demand for life insurance business increases. As the assets of people and business enterprises increase in growth process, widening of the economy, demand for new types of insurance products emerges. This statement of Sri C. Rangarajan, the then Governor of Reserve Bank of India and well-known economist, enlightens the key role of the insurance in the economic growth of a country. Insurance plays multifaceted role in the society as it provides protection against vulnerabilities like health, accidents, disasters and many other losses caused to assets and people on happening of uncertain events. It promotes economic efficiency by risk transformation, risk pooling and risk sharing techniques. It aids economic development through its financial intermediation function by providing low cost and long term funds for development activities. In precise, the insurance business helps to increase the public savings and deployment of funds as investments for development under cooperative system. It mobilizes resources, accelerates and stabilizes the economic growth of a country. A developed and constant evolution of insurance sector is a boon for the economic development of a nation, since it provides long-term funds for infrastructure development of that particular nation and at the same time strengthen the risk-taking ability of the citizens of the country. Concept of insurance. The concept of insurance has emerged to save the owner of the asset from the risk of damage or loss of the asset. Every asset in normal circumstances generates some income, and the destruction or damage of asset results not only in the risk of losing the asset but also in the risk of loss of income which is being generated. This loss of income from asset is indirect, whereas the loss of asset is direct, and affects the national income and financial security of the people. The growth of insurance concept has removed the fears and anxieties of the owners from the future uncertainties affecting assets. The risk of uncertainties may be of physical risk of assets, financial risks, commercial risks, and are met with insurance. But the speculative risks are not covered by insurance. Thus, the insurance is a risk transfer mechanism by which one organization can exchange its uncertainties and losses to ascertained contribution and thereby receive compensation of loss is suffered by it from the common fund of insurer. The insurance mechanism has two fundamental characteristics: shifting or transferring of a risk of loss or damage of assets from owners of the assets and sharing of losses by all the members of the group. Though the insurance mechanism cannot avoid the risks exposed to an asset and save the asset from the risk, it saves the owner from the financial loss on destruction of asset. Evolution of insurance business. The expansion of the British Empire across the world has triggered the growth of its export and import business and overseas transaction through ships. The increased overseas business has increased the risk of loss of goods and vessels carrying the goods to colonial countries. Though the insurance has taken its birth in Italy, but insurance took its real shape with the present form in the Lloyd's Coffee House on the banks of River Thames in England. Some of the business people meeting Lloyd's Coffee House in London started forecasting risks associated with the international and overseas export and import business, started issuing slips assuring the safe return and against the loss of vessels, ships, and also cargo on payment, which later is termed as underwriting. Owners of the Lloyd's Coffee House encouraged the business of underwriting by providing the customers with the pen, ink, and shipping information obtained from the waterfront. Thus, the concept of underwriting of insurance business starts from the Lloyd's Coffee House, spread across the globe. The marine insurance business is the first type of insurance business which later extended to fire insurance and life insurance businesses. The insurance business in India has developed along with the growth of export and import business of the East India Company and British Empire in India. The insurance business in India initially covered the imports from England and other countries. Thus, marine insurance business in the initial stage is the business carried in India like in England, and thereafter the same was extended to other business like life insurance and fire insurance. For the first time to undertake the insurance business in India, Madras Equitable Life Assurance Society was formed in 1829 to undertake the business in the Madras province. The Oriental Government Security Life Assurance Company started its business in 1874. All these companies followed the old rule of discrimination with the nationality and charged the extra premium from the Indian policy buyers. In 1871, the first Indian company, Bombay Mercantile Life Assurance Society, started its business in India at normal rates of premium. The Oriental Life Assurance Company started in India in 1927 and for the first time with the extra premium issued the life policy to Indians. Thereafter, many insurance companies mushroomed to undertake the insurance business in India. But These insurance companies were fragmented and focused certain local business, and there were great variation in premium calculations and claim settlement. After the independence, in order to bring uniformity of the premium charging and assured quick claim settlement, all the existing small insurance were brought under one umbrella by passing an ordinance of nationalization of insurance business. The nationalization of life insurance business in 1956 has brought about a great change in the field of insurance and opened new avenues for the growth of life insurance business in India. In the year 1972, a separate legislation for nationalization of general insurance business was made to bring all the non-life insurance business under the cover of single insurance company, the General Insurance Corporation of India. There was wide growth of the insurance business, life and non-life insurance business after nationalization of insurance business. However, when the huge insurance business and employee base, the insurance companies started monopolizing the insurance business and concentration was at the urban centers. In order to find out the solution for monopolistic nature of the insurance company and to further penetrate the insurance business into rural and social groups, a committee was formed under the chairmanship of R.N. Malhotra. The committee was appointed with an objective to bring reforms in the insurance sector on line with the reforms proposed in the financial sector. The committee has recommended for opening of the insurance market for the private players based upon the recommendations of the R.N. Malhotra committee, the involvement of private insurers in the business and to have strong regulatory system to control the insurance business was felt. On these recommendations, the Insurance Regulatory and Development Authority IRDA was established to regulate the business and make regulations for benefit of the insurer and insured. The authority has made regulations to govern the life insurance business and also the reinsurance business of the life insurance. Accordingly, the insurance market is opened up for the private players. Today, the insurance business is flourishing with 28 general insurance companies and 24 life insurance business houses under the government and private players. Now, let us know about insurance business classification. The classification of insurance business is directly related to the classification of the insurance laws. Experts have utilized different yardsticks to classify the insurance business, operating under different situations and also considering the applicability of law and nature of the risk covered. There are various classifications in use in India considering the different yardsticks such as time period of insurance policy, nature of the risk, coverage, nature of the risk and happening of event, nature of the subject matter or insurable interest, external nature, insurance business and purpose of insurance businesses. Some of these are as follows: first and third party insurances, personal property and liability insurances, voluntary and compulsory insurances, personal, commercial and social insurances, long term and short term insurances, official classification and life and general insurances. The life insurance business contains term policies, endowment policies, annuities and pension policies. The general insurance business consists of marine insurance, motor vehicle insurance, fire insurance, liability insurance and other miscellaneous policies such as insurance against theft, accident, health, natural calamities like earthquake and floods, etc. Insurance definition. The term insurance is not defined anywhere in the Insurance Act of 1938 or in other law related to the insurance business, but The Insurance Act 1938 has defined various types of insurance business such as marine insurance, fire insurance, general insurance, life insurance, and miscellaneous insurances. This non-availability of definition of insurance has created confusion in understanding insurance and its problems. In Lacune versus Crawford 1806, the insurance is defined as a contract of insurance is a contract by which one party, in consideration of the price paid to him adequate to the risks, becomes a security to others that he shall not suffer any loss, damage, or prejudice by the happening of perils specified to the certain things which may be exposed to them. It also explains the scope of insurance contract as to protect men against the uncertain events which may otherwise be of some disadvantage to them. The law lexicon defines insurance as a contract by which one party, in consideration of a premium, engages to pay agreed sum on certain event or indemnify another against a contingent loss. Accordingly, insurance is a plan by which large number of people associate themselves and transfer to the shoulders of all the risk that attach to an individual. Insurance can also be defined as a social device providing financial compensation for the effects of misfortune, the payments being made from the accumulated contribution of all parties participating in the scheme. The Haryana State Consumer Commission has defined the insurance in Girdhari Lal Bansal versus Oriental Insurance Company Limited that insurance has been stated to be a contract either to indemnify against the loss which may arise upon the happening of some event or to pay on the happening of some event a sum of money to person insured. Thus, the insurance is a financial risk management tool in which the insured transfers a risk of potential financial loss to the insurance company that mitigates it in exchange for monetary compensation known as the premium. Insurance is a contract under which one party, in consideration of receipt of a premium, undertakes to pay money to another person on the happening of a specified event. The insurance containing the terms of contract is known as the insurance policy. After considering aforesaid definitions and concepts, it can be understood that the insurance is a contractual arrangement in which one party agrees to take the risk of another person's life, property, or liability in consideration of certain comparatively small periodic payments. Insurance is an instrument under which individuals, businesses, or organizations or entities, in an exchange for a payment of sum of money or guaranteed compensation for losses arising from certain perils under specified circumstances. Now, let us know about reinsurance. Reinsurance is the purchase of insurance by an insurance company from another insurance company known as the reinsurer to provide protection against the large losses on cases it has already insured. It is insuring the insurer. Reinsurance is the insurance of a risk exposure by a primary insurer. An insurance company reinsures itself to protect against the risks to which it subjects itself in the conduct of insurance business. The law lexicon defines the reinsurance as the additional insurance on the same risk and occurs when the insurer considers that he has incurred too great a hazard and reinsures with others, so as in case of loss, the liability will be more widely distributed. It also further defines to state that the reinsurance is a contract whereby one party, called the reinsurer, in consideration of a premium paid to him, agrees to indemnify the other against the risks assumed by the later by a policy in favor of a third party. Reinsurance is insurance by the first insurance of a whole or some part of his interest in the risks created by his contract of insurance, or it is otherwise defined, it is a contract that one insurer makes with another to protect the first from a risk he has already assumed. The reinsurance is carried by entering into agreement or according to the treaties. Reinsurance business is based on the theory of risk distribution. It is a transaction of insurance business in which the reinsurance agency is the buyer and the original insurance is the seller. The reinsurance is a contract of insurance by which the reinsurer insures the insurer. In original insurance contract, the insurer undertakes to indemnify the insured from the loss against the risk for which the insurance is made. In reinsurance, the loss suffered by the insurer while indemnifying the insured is compensated. In other words, the original risk insured is extended to the reinsurer. In reinsurance, apart from the contract between the insured and the insurer, there is a separate insurance contract between the insurer and the reinsurer, for which the insured has got insurance from the insurer. The reinsurance contract is a contract to indemnify the direct insurer on the terms and conditions originally agreed upon at the time of insurance. It is the distribution of excess business of the insurer to the reinsurer. The contract of reinsurance business is on par with the insurance contract in relations to the possession of the characteristics like insurable interest, principle of indemnity, and principle of good faith. The insurer and the reinsurer should act with the good faith as the insurer and the insured discloses the information in good faith. All the legal principles of insurance contract are applicable to the contract of reinsurance. All the essential elements required to formulate the insurance contract are also required to formulate the reinsurance contract. But the contract of insurance and contract of reinsurance are two different, independent contracts. The reinsurance business provides confidence to the insured, and the original insurer creates a capacity to underwrite huge risks. Reinsurance provides the stability and flexibility to the insurer and insured. It acts as a shock absorber for stabilizing the loss ratios. It will reduce the impact of each risk by spreading the risk. In this process, the insurance can only recover the original loss. The reinsurance contract is subjected to the terms and the conditions of the original contract of the insurance and benefits available under the policy. Reinsurance policy covers actual loss and appears to be a contract of indemnity. The claim assessment made by the insured and crystallizing the liability will bind the insurer. If the original contract of insurance is altered by the insurer and insured, it will discharge the reinsurer from the liability. The reinsurance policy and original insurance policy are coexisting, and date of maturity of original policy binds the reinsurer. On expiry of the original insurance policy, the reinsurance policy also expires without any further notice to the reinsurer. The reinsurance business is operative in both life and general insurance businesses. The insurers having the requisite capital base operate the reinsurance business. The requirement of share capital to start the reinsurance business is rupees 200 crores, which is in addition to the preliminary expenses and deposits to be made. The reinsurer collects the funds from the parties interested to share the reinsurance, and common pool of funds is made. The persons interested in the reinsurance enter into a treaty and arrangements of insurance terms between the reinsurer and insurer on technical and financial terms applicable to the reinsurance business. Class or classes of insurance business to be undertaken or prepared. They are bound to programs of reinsurance with an objective to maximize retention amount within the country. Develop the adequate capacity of reinsurance to serve the best possible protection of the reinsurance loss incurred and signify the administration of the business. Every reinsurer has to undertake certain percentage of reinsurance business in India as a mandatory. Now I think you understood the meaning, nature and the concept of the insurances and various types of insurance business and the evolution of insurance business in India and across the globe. Thank you very much.